Thank you for joining us. I'm very humbled to be joined by such an esteemed panel here on stage. And every single one of these people brings a slightly different perspective on this emerging technology. And what I'd like to do today is deep dive or double click into every single one of these perspectives. But first, let me introduce the panel. Sitting next to me here is Micah, representing Discover, is a technologist and a head architect, and also is an expert in commercial payments, so we'll be sure to touch on that. Andrew next to me from Norton Rose Fulbright is a legal expert on a variety of different topics, but has been particularly focused on tokenization, ICOs, and other areas of blockchain implementation. We're also joined by Puneet, representing Citi, and is the head of financial market infrastructure for the organization, amongst many other things, and probably is one of the few people that truly understands the integral plumbing of the capital market system. And as we talk about blockchain, that's going to be a very relevant topic for us. Last but not least is Alex Tapscott, who's an author, investor, advisor, and the co-founder of the Blockchain Research Institute. Now, let's stay with Alex for just a second, and let's help us go back to a couple years back when blockchain first emerged on the financial market spectrum. Alex, do me a favor and paint a picture of what the original blockchain promise was and how has it matured since we started.
Yeah, sure. So thank you very much. It's an honor to be here today. I think the reason that people are so excited about blockchain and the reason that I've dedicated my professional life to it is that blockchain really represents an evolution in how we think about value. So for 30 years, we've had the Internet of Information, and it's been this powerful medium that's changed how we share and how we access and how we communicate. But it actually hasn't worked as well for transactions, for financial services, and for other movements of value because it's an information medium. It's not a value medium. So when you need to move value online or offline, you still need to rely on an intermediary to establish identity and to create trust, and then to perform all the business logic like clearing and settling, contracting and record keeping that basically makes commerce work. So with blockchain, what we have is an evolution from an Internet of Information to an Internet of Value. So the best way to think about it really is the first digital medium for value. And as a result, it's going to have as great, if not a greater impact on the economy than the Internet. Because while the Internet changed a lot of information industries like communication, media, and the like, blockchain has the potential to change value industries like financial services. And the financial services industry and other sort of value-based industries are much, much larger. So the original conceit was that Bitcoin was bad and blockchain, the underlying technology, was good. And that was sort of the mantra in the sort of 2015, 2016 period. And I think that as people in the industry, in the financial industry and others have become more educated and sophisticated, they realize that it's a little bit more complex than that. This isn't so much that you can separate the two things. In fact, crypto assets themselves, of which Bitcoin is the largest and the most well-known, are actually essential to the future of financial services. So I think today, we look at the industry, and I think the financial industry is complex and has a complex taxonomy and language, and I think sometimes that's intentional. It's meant to sort of obfuscate what's going on. But really, the financial industry does sort of 8 essential things. It gives you a way to prove identity, KYC, AML, a way to move value, a way to store value, a way to access credit, a way to access funding through public markets or venture capital, a way to insure against risk, and a way to account for and organize financial information. And each of those different functions is going to be transformed by this technology. So really, you can kind of think of it as this immovable force of blockchain is coming up against this unstoppable force of blockchain is coming up against this immovable object of the financial industry with all of its business legacy and installed systems and regulatory regimes and the like. And so the conflagration or the explosion that's sort of going to happen is going to be quite interesting. And my view basically of the practitioners in the industry, of which I'm sharing a stage with some of the leaders, is that there are a few ways that you can approach this. One is to say, this is not really that relevant to my business. Maybe it affects 1 or 2 certain aspects, but generally I'm going to ignore it. I wouldn't really recommend that strategy. The second strategy is to say, this could actually reduce significantly the complexity and the cost of my own business. So this could actually be a massive boon for savings, and I can reduce my reliance on my own intermediaries and counterparties and the like. And that's important to think about it. You know, it's important to think about driving costs down. But if you only focus on how a technology is going to change the way you do business today, you may miss how it could impact the market and the industry in which you operate in the future. So I always say the best sort of mental framework to use is not so much a cost-saving framework, but rather a revenue framework, right? What are the ways in which this technology can enable my business to do things that it couldn't do before, to create new products and services, to access new markets and customers, in the same way that the internet created new opportunities that would have scarcely been, you know, evident at the early stages of that technology. So it's a forward-thinking growth, you know, focused mentality, I think, is the right way to go about it.
Yeah. No, it's an interesting mental model. Pivoting that a little bit into say, we have our goalposts that are out there that are worth pursuing, and everybody collectively is moving towards that at a snail's pace to an extent, but that is what it is. But if we talk about, you know, enterprises and having the ability of having the need to deliver value to clients today, having the need to address real issues that reside in this ecosystem today, is this a method to do that? So maybe I'll go to Puneet and ask the following. What was it that interested you or the organization, Citi, with this technology? And maybe you can spend a few minutes on that.
Thanks, Artem. It's an honor to be here, and thank you, Alex, for the great introduction. As we started looking at this now, I look back and say it's almost 4 or 5 years. We tried to deeply understand the technology. We wanted to understand what it can do. At the same time, what are the other issues which are associated with it as you look at it from a financial services industry construct. Few things which stood out from a core functionality perspective. The first one was the distributed nature of the data. So counterparties currently reconcile with each other in multiple formats and not in a very consistent manner. Is there a way that you could actually have shared databases between counterparties and hence they are in consistent reconciliation? And then add to it on top of it, if you have a shared database, can you write stored procedures, which are essentially smart contracts, which operate on the data and hence manage the transaction lifecycle in a very consistent manner? So you take the shared database, you put smart contracts on top, effectively drive a different paradigm from a post-trade processing perspective as an example, or there could be other multiple applications just on a similar basic construct. So that was pretty exciting. We, at the same time, wanted to ensure that the financial services industry is becoming more and more resilient. And could this technology, through the structure of databases where the data is shared between nodes, add added layer of resiliency on top? So you start putting all these pieces together. That was essentially the value. At the same time, there are specific challenges which are out there and which cannot be ignored. Data confidentiality. It's more important now than ever before, and we want to make sure that all the projects which are being worked on in this area are actually adhering to that. Resiliency, throughput, scalability. The operational risk, while we are mitigating operational risk of one nature, we should not introduce new operational risks in the mix, be it cybersecurity issues, et cetera, et cetera. And hence, a lot of work over the last several years have happened in creating this enterprise blockchain construct with a number of companies, both proprietary and open source, building solutions which actually enable addressing those issues while at the same time bringing value. And we can talk through those use cases as we go through this discussion.
Interesting. So it's interesting to hear kind of the ambitious goalposts of where we're moving to and real tangible implication or applications or pain points that need to be addressed today. Andrew, you work with a lot of issuers, investors, institutional clients broadly. Can you share a little bit of that perspective with us? What was the appeal to the technology for you?
Sure. So, you know, I think the main appeal is that you get a database that's, you know, trusted in a way that a lot of other databases aren't. And there are a lot of things that you can do once you have that data, you know, once you have intermediaries out of the picture. And of course, you know, I'm sort of sitting with a bunch of intermediaries in a way. But, you know, you can do things faster. You can eliminate errors. You can slice and dice things into smaller pieces. One of the interesting things, I got into this area, you know, not necessarily in blockchain directly, but in FinTech, in peer-to-peer lending, and, you know, securitizing some of those loans, right? With blockchain technology, you can take cash flows and other assets and put them into smaller pieces in a much more efficient way and sell them to more people and trade them faster. And you can verify the underlying data in ways that you couldn't before. So that's been really cool to see that change and how blockchain is a solution to some of the things that we've been trying to do for a long time, and now sort of starting to bring some of those out to the market.
Great. Micah, Discover brings a slightly different perspective, I would argue. Share some of those perspectives with us. What was the appeal?
Yeah, for us, the big appeal is everybody thinks of us just as a card program, but we're much bigger than that. We're a bank. We have personal loans, student loans, but we're also a network very much like Visa, MasterCard, Amex are networks that help connect it. And when we first heard of the technology and started looking at it, we immediately saw that there was potential to disintermediate the networks in general. So it's something that we immediately looked at and said, we need to pay close attention to this. But then as we dove deeper into it, we started seeing where, from a network perspective, it can bring a lot of value to what we're doing and enable some things that we weren't able to do in the past and potentially improve upon existing systems that are out there today where there's not necessarily good sharing of data available today, that the technology gives you that ability to share the data between the different parties that need to be able to see it, need to be able to rely on that data, which can then reduce risk to them, ultimately reducing cost to the customer. So we keep a very close eye on that to do it in that manner. But we also look at it and ways to improve the existing systems that we have today. So from my commercial payment side, we're a member of the Business Payment Coalition from the Federal Reserve of Minneapolis that was looking at how to improve business payments overall. And one of the things that was identified was the need for a directory for payers to be able to look up the payment credentials of the payees in a secure way. We started looking at that very closely and quickly realized that blockchain was a great solution to that because using traditional systems to solve that ultimately created a nice little honeypot of sensitive data that people could attack.
And that goes to Puneet's point about
Right.
privacy and confidentiality.
Definitely. But using blockchain and the smart contracts, you're able to store the sensitive data on the edges at trusted entities that already have high regulation around them, already store that data in a secure way, and not share it in a centralized location, but have a centralized way of being able to access that data, still giving control to the payees on who can actually see their sensitive data through smart contracts, et cetera.
Interesting. So actually, that's a very good segue into starting again. The promise, the vision, the interest to the institutions off the get-go. But then you have to essentially set some hypotheses and then verify them, ratify them, or disprove them. And that really is the application of this technology, the piloting, the proofs of concept that are now maturing to implementation use cases. So maybe we can spend a little bit more time on that. And Puneet, if you can share some real applications of DLT within your organization or more broadly.
Sure. So as we start looking at this technology, kind of realize that 4 things are very critical for adoption of this technology. First is you need the network. Really, one institution implementing a solution within themselves doesn't really make much of a difference. You need the entire network to come together. Hence, the use cases which will actually become scalable, which will have material impact, will require the network where financial market infrastructures, counterparties, clients, FinTech firms all work together to drive that benefit. Second thing was about the technology maturity. This technology has come a long way, but we want to make sure as it gets implemented that it is meeting all the requirements we would have of any technology when we implement it. The third piece was around the cost benefit, that we are not implementing it just for the sake of it, because that will not really lead to much good results in any medium to long-term scenario, where we're just doing POCs and then leave it right there. Again, does not really make much of an impact. But are these true business use cases which will have impact at scale to institutions, which will actually create the right kind of framework to drive more innovation on top of those? And lastly, and not leastly, is most important part is the legal regulatory framework. In each of these technologies, how is it meeting the legal regulatory framework which is required of us, of counterparties, of clients, and the broad ecosystem per se. So some of the use cases I want to call out which are kind of substantial. The first one, we've been working on it for the last couple of years with DTCC, which has something called Trade Information Warehouse for credit default swaps. Almost $11 trillion of notional resides in that data. And over 15 financial institutions, buy side, sell side, have been working together to drive that platform into a DLT-based platform. And we hope that once it's implemented, it could actually give us benefits broader than just having kind of the benefits as emphasized now, but create new services around it. That has been pretty useful, and hopefully you will continue to see progress reports on that in the press as it goes along. The second one, which is very interesting, is with CLS. For those of you who do not know, CLS is the platform which settles global FX trades. So globally, all the FX trades, essentially across 18 currencies, get settled multilaterally, netted and settled in CLS, hence effectively reducing the risk from a settlement risk perspective, enhancing the liquidity, reducing the liquidity requirements, and as such. The new solution which has gone live with CLS is called CLS Net, which takes into account all the other currencies which were not currently covered by CLS and allows counterparties to net those through, again, the shared database structure. We think, again, it's very valuable. It drives immediate benefit. And it is in a fairly regulated environment within CLS, which is actually governed by 18 central banks, with Federal Reserve being the primary regulator. So those are kind of two interesting use cases. The third one, which we've been involved in, again, with a number of large corporations and financial institutions, is around trade finance and commodities trade finance. A project called Comgo, which to some extent went live earlier this year, which with intent to actually streamline the entire supply chain process around commodity trade finance, including LC issuances, credit intermediation, all the way through in a stage-by-stage manner. So pretty substantial, these ones. We definitely have a lot of projects which are under assessments across our businesses, across geographies, and we continue to evaluate how it makes sense from a city perspective, from the broader market adoption perspective.
Interesting. So, and you hit on a couple points there that were very interesting. All of them were true, but a couple were especially interesting to me, especially around, operating within the existing regulatory frameworks. And I think one of the primary differences there that's worth highlighting is that every use case you've highlighted here is a permissioned network, essentially, right? Where the users are KYC'd and onboarded accordingly, right? That's a little bit different than the original vision, and I see Alex warming up his hand because he wants to say something.
Just an observation from Puneet's comments, which is that there are lots of different stakeholders that are involved in scaling a use case, any of the use cases that were described. And we always say, blockchain, especially when it comes to the enterprise and to financial services, that blockchain is a team sport. That all financial technologies are effectively relying on network effects. I mean, if you're the only person in the room with a Bloomberg terminal, it's helpful to get information, but it doesn't allow you to communicate because no one else has one. So the more people that are connected into a network, the more useful that network becomes, right? It's sort of an obvious observation, but it's very true. And in these industries, you're asking, companies that they're basically like frenemies, right? They're competing with each other in some ways, and in other ways they need to maybe cooperate on shared infrastructure, shared data sets, and shared information. So it's quite a challenge. And from my observation, I think that there are a lot of big companies and banks that are very sincere about their intention to use this technology, and I think they recognize there's a big opportunity. But I think a lot of the innovation that we've seen over the past few years hasn't been happening always in the big companies. It's often happening on the margins, in the startup world. And I think that if you look at the biggest sort of use cases for blockchain, really so far, in terms of putting into practice, would be Bitcoin as a payment mechanism, as a store of value, as a sort of hedge against political risk in places like Venezuela and elsewhere, and fundraising. So what's really fascinating about the fundraising is that if you look at what happened during the ICO boom, almost $10 billion of value dollars were US dollar equivalent were raised for companies and projects in the space. Now I'm not providing a view or opinion on the merits of any of those projects, but what that period in time demonstrated is that, you know, if you're an entrepreneur, regardless of where you are, if you've got a good idea and you can identify a market, you can raise money peer-to-peer. You know, traditionally we had to rely on angels and VCs and public markets and exchanges and all of the other traditional intermediaries, and now there's a mechanism to do that peer-to-peer. So, you know, I look at the work that Citi is doing and others are doing, and I think it's very fascinating. And I think that it's probably going to take some time before the technology innovation that's happening on the margins is sort of mature enough and stable enough that, you know, big banks will actually be able to embrace it. Because if they could, I mean, there's an opportunity to become, you know, a platform to connect participants in a marketplace, whether it's through payments or fundraising or credit or what have you. And that's really, I think, dependent on the scaling and growth and maturity of some of these public platforms. But I think today, you know, you're not going to move the NASDAQ or the New York Stock Exchange onto the Ethereum network because that network doesn't have the capacity, it doesn't have the scale, and it's still sort of working out its kinks. And I would just say that, you know, if you look at other public technology innovations throughout history, oftentimes it took a while before you could move critical infrastructure and business onto it. But my view, to sort of conclude the thought, is that it's not so much a matter of if, it's a matter of when. And in the meantime, all of these innovations that big companies are doing, I think, are extremely useful to prepare themselves for that eventuality.
So Alex said it's a team sport and it's full of frenemies. And I think one of the things that's different about financial services and blockchain compared to some other industries is, you know, in financial services, you have all these different companies that are linked and have to play on the same systems. And so, you know, you look, you know, I think, Puneet, you had mentioned 15 banks were doing something together, right? When you have that frenemy aspect, one of the legal issues that comes up is antitrust. And I think people don't talk about that as much. But, you know, you've got, let's say you've got 15 banks working on a project over here. You know, you've got, you know, 10 other banks working on a substantially similar project over here. And who's going to do it better and which one is going to get adopted by the industry? Or maybe they'll both continue as competitors for a while. But, you know, when you're having those meetings, having those discussions, you know, working on building out that platform, one of the things that as lawyers we really worry about with clients is, you know, what information are you sharing and is that allowed and how does that all work? And you know, worrying about, you know, competition law, antitrust, those kinds of things.
Interesting. And then if you can address one more point that Alex raised, which I thought was interesting, was around crowdfunding or issuing, raising capital. Now, you've worked with quite a few issuers, and one could argue that one of the primary drivers for opening the floodgates to the realm of ICOs is less around blockchain and more about regulatory permissions or the Jobs Act, for instance. Any thoughts on that? What is it that, you know, DLT allows or enables the issuers that traditional technology may not?
Right, and so Alex had mentioned peer-to-peer. So, you know, whether it's, you know, an issuance under the Jobs Act directly to, you know, retail investors, or, you know, you're taking something more complicated, you know, let's, you know, think about leading into the financial crisis, you know, the big bad structured products. You know, as a concept, a structured product isn't so bad. It's just a lot of them were full of, you know, all sorts of stuff and nonsense. And, you know, if you were an investor, whether you're a retail investor or an institutional investor, you know, looking at investing in a structured product back in, say, 2005, let's say it's a, you know, a pool of 1,000 loans. Maybe you would diligence 10 of those loans. And, you know, you would have some computer program that wasn't so super sophisticated tell you that, okay, we can extrapolate from these 10 the rest of the 1,000. And it just didn't work. So now if you have the loans and maybe even the title, other you know, panels and speakers have talked about, you know, putting real estate title on a blockchain, other things on a blockchain, right? So if you have mortgage loans and you have the title record on a blockchain, that can be diligenced every single title by a computer relatively quickly now, right? Then you have the loan on a blockchain. That can be diligenced too. So you can package things in ways that they've always been packaged, but now the package is a lot more transparent. And so you can avoid some of the problems with some of these products that we've faced historically. The other thing that you can do is now that you have a more organized, more trusted, more accessible database, you can slice and dice the product or the cash flows or the ownership or whatever it is into ever smaller pieces. And you can track the ownership of those smaller pieces now in a way that was more efficient. So in financial services, a lot of this is not today necessarily groundbreaking, crazy new things. It's getting the things that we've done for a while faster and more efficient. And if I'm a regulator, that's actually pretty cool. So, I think part of it is, we talking to clients, how do you shorten the settlement time for trades, right? And all those sorts of things. Again, so blockchain can give you a solution to problems that the industry has been facing for quite some time.
Perfect. Thank you. Go ahead.
If I may jump in there real quick, kind of touching on a couple of those comments from both sides. We've been talking about it being a team thing and how do you get there. My personal opinion is we're definitely going to see it become mainstream at some point, but there's a couple of things there that prevent it at this point. A lot of that is the comfort level of the banks, no doubt about it. But I think we're going to see an evolution where a lot of companies and a lot of financial institutions and networks are going to be looking at how do we use the technology to help drive to the payment. And that evolution will ultimately be what brings to the table the ability to use the technology to actually execute the payments in real time. And we do see a couple of companies out there already, a couple of banks out there that are doing it to help move assets internally, but it's not in an open manner where everybody can easily access it. It's very geared towards capital money movements, et cetera, where one of them has a requirement that you have to have at least $250,000 in the account in order to use the technology. Very restrictive from that perspective. I don't know about you. I know I don't have $250,000 to put into an account to be able to use the technology today.
Wait, you didn't get paid to speak here?
No, I did not. I think I actually paid to speak here. But well worth it.
So it's an interesting, you just introduced kind of a interesting mental model in a sense, right? There's scenarios for leveraging the technology on a more peer-to-peer based communication to establish payment rails. And the other component is actually tokenizing the asset itself or the value as cash, right? Tokenized cash. And there's a variety of different names for it. But Alex, maybe I can jump to you here and share a little bit of your perspective and maybe some research from the Blockchain Research Institute. I know there's been quite a lot of publications on that topic.
Yeah, I think the key thing is that not all crypto assets are the same thing. They're not all created equal. I think a lot of people look at the world of crypto assets and they first of all think that the crypto asset world, tail is shaking the blockchain dog, so to speak, and that it's all about crypto. And the fact of the matter is that there's a lot more to it than that. But within the crypto universe, not all of these things are currencies per se. And I think that's really important to make very clear. There are things that are designed to be currencies like Bitcoin, which is a medium of exchange, a store of value, a unit of account, et cetera.
All three of those things? Just kidding.
Well, yeah, I mean, long term, it's worked at all three of those pretty well, right? So depending on your time horizon. It's the past 12 months, maybe not so much. That's what Bitcoin does. But there are also different kinds of assets that are out there, and we've done a taxonomy of it, and it might not be exhaustive, it might not be complete, and it could change over time. But basically, you've got currencies, you've got protocol tokens for networks like Ethereum, you've got utility tokens, which are these, basically native digital assets that work inside of an application. Very skeptical on those personally. You've got security tokens, which are effectively, digital assets that represent a claim on some, other asset, some legal right, like an equity or a bond or something like that. You've got natural asset tokens, which are anchored to some asset in the real world, like say, a condo or a barrel of oil or, a bar of gold or something.
Like the physical asset or digital or a contractual representation?
Well, so the representation in the token is allows you to sort of clear and settle it instantly, but there's still a physical delivery component to it. So I think that in that instance, for example, the blockchain only gets you sort of half the way there. I mean, in the end, if you have a futures contract that has a a delivery date and a settlement date, then you still actually have to, there still has to be a human component to it. Then you've got NFTs, which are non-fungible tokens, which is basically like a crypto collectible. So, you know, there are going to be 21 million Bitcoin out there eventually, but there's only, you know, one of a certain Van Gogh or Rothko or whatever. And so there are all sorts of digital assets that are similarly very scarce. So digital artwork, you know, collectibles, assets with inside of ecosystems like inside of video games, et cetera. So all of those things are NFTs, are singular and unique assets, which is a fascinating category. And then the last category would be stable coins, which are can take various forms, but generally are like collateralized dollars, basically. And so like what Facebook is potentially planning on rolling out is sort of a stable coin that's going to be pegged to the US dollar that can be used inside the ecosystem and maybe outside the ecosystem. That's all to say that that's 7 different types of crypto assets. And you know, each of those different types could have a very big impact on the financial industry. And I actually think if you look at the ICO revolution, you know, a lot of companies, a lot of projects backwards engineered themselves into a utility token when probably what they should have just done was issued equity in their startup. But the mechanisms didn't exist at the time. You need the technology infrastructure, which I think is growing quite quickly. You also need the business infrastructure. And then most importantly, as other panelists have said, you need the regulatory infrastructure. So I think as these different, you know, until that scales, I think it's going to be tough to make this full transition. But when it does, you know, there's no reason why you can't clear and settle transactions and financial assets peer-to-peer in the same way that you can do it today with crypto assets, because the technology tools exist. And so as more and more assets get put onto, you know, the blockchain, as more and more assets become crypto assets, you'll begin to see markets migrating from their current analog sort of format to a fully digital format. And to me, that's very exciting because it means reduced settlement time, it means reduced costs, but more importantly, it means broadening access to financial services for people who maybe don't have access to bank accounts today because they don't have an identity or they can't, you know, get access to it. So to me, that's sort of like the long-term, you know, positive outcome of all this is that it means greater participation and growth in the economy.
Interesting. Thank you for that. So again, I'm enjoying kind of jumping from the future and the promise and for the need for trusted and regulated organizations to do real stuff today and to ultimately break stuff, right? Really figure it out and break it and continuously move towards some version of that vision and how it evolves. And I think it's important to note, and I think you'd agree, is that vision continues to evolve as we learn as a capital markets ecosystem, as a broader crypto-based ecosystem. All of our mental models continue to shift and evolve. And the one thing that I can probably say with certainty is that the only thing we all ultimately know is that we will continue to evolve and shift and shape our mental models as we move. We have just probably a minute left. Kind of wanted to do some quick closing thoughts, and maybe we'll start, Puneet. Maybe some closing thoughts on your end, and we'll go around.
I think I can agree. This is a process of evolution. We have to see what you can implement now, what is available vis-a-vis technology now, what problems you're going to solve, but then effectively, step by step, moving towards what is ultimately possible. We're not there yet. I'm sure a lot of work which is happening across the industry, across FinTech world, across regulated financial institutions world, broadly everywhere, which effectively will enable a lot more progress. So definitely align with that.
Great. Andrew, anything?
Yeah, I mean, I think, you know, Alex mentioned market access. You know, I think there are a number of places where financial products don't exist, and, you know, blockchain and other technologies combined can bring that. I think from a regulatory perspective, you know, there are market access opportunities that the technology brings where there actually is not a regulatory framework yet because that market has never been accessed before. So that'll be an interesting thing to watch and see how that develops and how we can influence that process.
Micah, any last words really quickly?
Yeah, I going on the evolution, I definitely see it happening, especially the mindset around it, where when we were looking at this about 3 or 4 years ago, everybody was coming to us saying, we have this blockchain solution that does this. Okay, does it really do that? May do it, may not do it well, but okay, we'll take your word for it. Now we are seeing that mind shift to, I have this solution that does this, does it really well, and oh yeah, it uses blockchain in the background, which I think is a great way to see this technology moving and start getting a lot more adoption because of that. And so a lot of that mind shift that has to happen and focus on what the product is and not necessarily what the technology is.
I really like that. I think to close it out, there will come a day when no one is going to care whether it's a blockchain or a token or anything else. Is it user-friendly? Does it do what I need it to do? So with that, thank you for your time, and thank you to our panelists.